Hi, I'm Steve Billimack, and I'm a partner with Hightower Great Lakes in the Chicago office. And as we kind of approach the end of the first quarter, we wanted to give you a little bit of an update on the markets and our thoughts on the markets. But before I do, our prayers and thoughts go out to the people of the Ukraine. We really do hope for a speedy recovery to end that crisis. It's been devastating for that country. And we are starting. We've seen the impact on the markets here. The S&P hit a all-time high in January, and we've pulled back about 12% from that high. And the Nasdaq, which is an index more of technology stocks, growing healthcare stocks, has pulled back about 20% from its November high. So, on the news, we've had a pullback, but even before the Russia-Ukraine news, we did expect this to be a more difficult year. We were optimistic, cautiously optimistic, but for a number of factors. I mean, the S&P 500 last year had a great year. It was up about 29%. A lot of that growth came from a handful of stocks, and most of it came from earnings growth. We even saw last year that the PE ratio, which is kind of the price for every dollar of earnings, actually came down a little bit last year, which sometimes happens after markets have a long run. So we knew that we had a strong last year in the markets. We knew it would be a more difficult environment for growth. We expect positive growth both from the S&P and from the economy, but the positive growth would be at a slower growth rate than we saw the prior year, because 2021 had very easy comparisons for companies in the economy compared to 2020, which was the initial year of the COVID crisis. We also had other factors going on. We knew the Fed would slowly begin to raise rates. And we've really, if we look back in time, we had a 40-year bull market in bonds end last September. So the 10-year Treasury was north of 15% 40 years ago. And over that time period, it slowly came down to about 1.2%. So as rates come down, the wind is really at the back of the bond market. It helps bond prices. And so we saw that that was slowly changing and kind of have had to rebalance portfolios anticipating, a new rate environment going forward. So again, there were, and then we also had geopolitical concerns, both not only with Ukraine at the time, but we're still obviously worried about things like Taiwan or the Middle East. So there's all these events that led us to be cautiously optimistic, but we knew it'd be a little bit more difficult year than the prior year. I guess to touch base on the war situation in the Ukraine, unfortunately, we've seen conflicts, short-term conflicts, wars in the past. And let me actually pull up an event of kind of how some of those have impacted the S&P. This was found by some of my partners in the Valparaiso office. And it shows some of the geopolitical conflicts and the drawdown of the S&P during those time periods. And if you look at the bigger ones, let's just focus on, like here you see Iraq's invasion of Kuwait pulled the S&P back about 16.9 or 17%. And you saw that really it was about a 2-month drawdown and about a 4-month or 189-day recovery. If we look at the biggest drawdown, which was the Pearl Harbor attack, the S&P came down about 20%. And there you see it took about 5 months or 143 days for the drawdown to happen and about 10 months for it to recover from that. So again, if we go back and we look kind of at our current situation year to date, and again, most of our portfolios are not all equity. They're diversified portfolios. So we have different parts of the portfolio helping out others. But the S&P or the bond market, the Bloomberg Aggregate Bond Index, which is kind of the core bond index for U.S. bonds, is down about 5.7 this year with rates being higher. The S&P is down about 12. The developed international market, or the EFA, is down about 11, so similar to the S&P. And the emerging markets are down right now about 14% through yesterday or March 14th. And what's interesting is actually the European and the emerging markets held up better early on during the Russia-Ukraine conflict, but in the last few weeks, we've seen them pull back. So again, it's a difficult quarter, and I think a lot of times we get the question, then what should we be doing in the portfolios? Hightower Great Lakes is a very when we put together portfolios, we're putting together long-term strategic portfolios, and we do rebalance at the extreme, and we do look for tilts from time to time, but we are not active market timers. An example I like to give my clients is, if we were trying to do 4 short-term trades in a row, and you could pick the market 50% of the time correctly. So basically a coin flip. In other words, if you were correct 50% of the time, what would be your percentage of picking all 4 of those trades correctly in a row? And it would actually be about 6.25%. So the odds are kind of against you trying to be very nimble, very quick on these short-term trades. And that's one reason we tend to have a much longer viewpoint, because that allows us to smooth out the trends, and it actually puts timing at our side. So I think that's important when you talk to people or see in the press that people may be jumping in and out of cash. We don't think it's prudent over the long run. The other reason it's besides just being correct on the decision, you have to be correct on the timing. And the timing, let me pull up a chart here. This gets a little bit to the timing or the lumpiness of returns. If you look at the last 15 years of the S&P, ending last year, from ending December 31st of 2021, and you invested $10,000 for 15 years, if you were fully invested the whole time period, you would have received roughly $45,000 and about a 10.6% return. However, if you missed the 10 best days, your return, you would have doubled your money to about $20,000, but your return would have dropped to about 5%. And that's because, again, many times the best days come after some of these dramatic pullbacks. So again, another reason why we like to be long-term investors is that it's hard to be nimble in the short term, and the returns tend to be lumpy and unpredictable to the market when they things might happen. The other thing that sometimes we get calls on is what about or putting a lot of assets shifting to a certain theme? And so, when you look at what's going on in Russia and you see the headlines in the oil, the initial response may be, well, let's put a lot of money in electric vehicles or things of that nature. But when you look at the fundamentals, you have to you see that they're really the new batteries, the longer lasting lithium-ion batteries, use about 90% nickel compared to about 30% from years ago. And Russia is one of the biggest producers of nickel. So again, you have to, sometimes that's again why we like the diversification, because we like different parts of the portfolio behaving at different times. And that's actually one of the values of having an advisor. Vanguard did a study a few years ago where they looked at the value of an advisor, and they looked at it adding about 3% return to portfolios. And part of that is behavioral coaching, which is the aspect of not selling it during difficult times in the market, and actually looking at selling when the market is very euphoric or overpriced. So two of the big benefits were behavioral coaching during these difficult times and rebalancing, and two of the others were a little bit more planning driven, such as the location of assets, and then prudent how do you do spending policies coming out of the portfolio. So again, that was again a reason that we tend to be very long-term focused and look at the holistic aspect of the portfolios and the client's need. So again, we're taking all this into account. I read a recent report by David Costin. He's the chief market strategist for Goldman Sachs, and he just reduced his S&P outlook for this year to 4,700, which is about a 12% return from where we are now. So again, looking longer term, not necessarily the next week, month, 2 months, but looking towards the end of the year into the following year, even looking at things like the Ukraine-Russia situation, rising interest rates, inflation, a chance of recession, all of those things combined, he's still looking at roughly kind of a 12% target towards the end of the year, higher on the S&P. So again, we'll see what happens, but again, that's why we're long-term focused, and we just wanted to give you some of our thoughts. If you have questions, please contact your Hightower Great Lakes advisor, and we appreciate your time and appreciate you being our clients. Thank you.